This session is devoted to explaining the basics, or if you wish, the fundamentals of accounting, financial statements, and so on, so that we give you an idea of what building blocks are needed to understand the analysis of financial statements. So we begin the process by talking about financial statements themselves and what they do, why they're prepared in the way they are, and what types of information they contain. In essence, the objective of financial statements is to tell you what resources a company has, where it obtained those resources from, how it used those resources during the period. The statement, or the collection, if you wish, of information regarding the resources and where the company obtains those resources from is called the balance sheet. The use of those resources is what we call the income statement. So let's take a look at how these transactions are reported and what is involved in the process. So the first thing I'd like you to keep in or think about is a company starts with a certain amount of resources. Let's say it's organized by the owners, or it can get started in different ways, but let's think about it simply as a group of people who get together and decide that they're going to sell a certain product. We can think of them as retailers because we're going to make the assumption that they acquire the product from somebody else who manufactures it, and then they sell it in their retail stores, or I guess we could make it get technically up to date and say that they're going to sell it on the web. So either way you like, but think of it this way. So what we have here is a company, a group of people that begins with some resources. And the way we'll think about this is that these owners will put a certain amount of their money into the company. All the assets, all the resources that a company has, those have to be obtained from either the cash that the company owners put into it or money that they borrow from outsiders. In other words, the assets that a company has at any given point in time, those assets are obtained, as I said, either from money that the owners have put into the company or from money that they've borrowed from outsiders. The money they borrow from outsiders is what we call liabilities. The investment of the owners in the company is what we call the equity. Now, I'm sorry, I guess we should have probably been burning incense or something because we mentioned something that's sacred in accounting, and that is this basic accounting equation. Assets are always equal to the liabilities plus the equity. All recording of transactions and events that's done in accounting follows this basic equation. Every transaction, when it is recorded, has to keep this equation intact. The objective here, remember, is to record the assets, record the use of those assets, and then, as I'm going to show you in a few minutes, how we get to the information that's provided by the income statement. So very simply, what you want to do is keep in mind that this is the start, if you wish. So let's say that the company's owners, we were talking, if you recall, about a retail store. The owners put in a certain amount of money. That money is used to buy a certain number of products that will be sold in this retail store, and it'll be used to, say, purchase fixtures, computers, etc., that are needed to run the organization. The company may also have borrowed a certain amount of money from, say, the bank, which would show up in your liabilities. When the company orders products, the amounts that it owes to suppliers will also be recorded in the liabilities. To give you an idea, I'm going to take you through just about, let's say 2 or 3 transactions, just to give you a sense of how this works. First transaction that I'll mention or that we'll take a look at is the owners put in, let's say, $100,000. In effect, what you're doing is you have added $100,000 to the equity. That $100,000 was put into the company as cash. Consequently, it shows up on the asset side. Notice that we've appeased the accounting gods. Our equation is in balance. We now go out and borrow, let's say, $150,000. That $150,000 gets recorded as the liabilities. Of course, it's received in cash, so we're adding the $150,000. Now note that this is a separate transaction. What happens to the balance, however, you can find that the balance itself will be as follows. You will have $250 in cash because you had the 100 to begin with from the owners. You've added $150 that you borrowed. That $250 in assets is offset by $150 in liabilities and the $100 in equity. And once again, the equation is in balance. So note what we're doing here is we're recording the acquisition of resources, and at the same time we're recording the source of those resources. Where are they coming from? Now what's going to happen over time is that we may use this cash that we have to buy the products that we intend to sell. So let's make a very simple assumption there. The assumption here is that we buy inventory, or for inventory, products that we intend to sell, about $75,000 worth, let's say. We promise to pay the suppliers 1 month from the receipt of those goods. Consequently, what we're going to do is record the receipt of the inventory. That inventory now, notice, adds 75 to our assets. Remember that we borrowed from the suppliers. We told them that we would pay them that amount later. Consequently, we're going to add 75 here as well. Of course, once again, it's very easy to see that the equation remains in balance because what you have here is 325 in assets, 225 in liabilities, and 100 in equity. Now, one of the things to keep in mind is that, of course, if we kept records in this fashion, in other words, if we commingled all the assets, we'd end up with a number that would be very, very hard to understand. You see, there's a very big difference. In this 325 that you see in the assets, 250,000 reflects cash. 75,000 reflects inventories, products that we intend to sell. Now, as one of my co-authors in my textbook, Jerry White, likes to say, it's very hard to predict, particularly the future. So the problem here is that we know we have cash of 250. We know what we're going to be able to do with it. That 75 in inventories is what we paid for the inventories today. If the interests of the market change, we may not be able to recover that 75. Or, say the opposite. All of a sudden, the product that we have becomes the most popular thing around, and therefore, it's worth a lot more than the 75. The basic idea, therefore, is that the nature of the assets is different. There is a need to record and inform users of financial statements of that different nature. Similarly, there's a difference in the nature of the liabilities. 150 of that is an amount that we owe to the bank. We borrowed that $150,000 from the bank. 75,000 is an amount that we have to pay back, or pay rather, to the suppliers. Chances are that suppliers are not going to be waiting as long as the bank. The bank's willing to lend us money maybe for a year, maybe for 5 years. Suppliers normally want their money back within 30 days, 30 to 60 days, maybe 90 days at most.